So I said the way to solve our problems, we need higher interest rates. Well, we're not going to get them. They're at zero. And here is the problem, and this is where the real crisis is coming. You know, when I wrote my book, Crash Proof, the crisis that I was forecasting is not the one that happened in 2008. I forecast that one. But I said that wasn't the crisis. That was the event that was going to start the crisis. Because I said the crisis was not going to result from the bursting of the housing bubble and from the ensuing recession and bank failures. I said the crisis would result from what the government does to solve that problem. So I said the U.S. economy would die not from the disease, but from the government cure. And that crash is still coming, and in fact it might come as soon as next year. And the way that crash is going to play out, it's going to be the form of a sovereign debt, a currency crisis in the United States. You know, we're seeing it right now in Europe, where nations are being held to account for having too much debt. And this process is not going to stop at Greece or Ireland. It's going to come across the Atlantic, and it's going to end in America, because we are the biggest offenders when it comes to debt and living beyond our means. And we're not going to escape this without having to deal with a day of reckoning. And if you remember, when the mortgage crisis first began, and it was the subprime market where you first saw the cracks and you saw the problems, just about everybody, you know, in Wall Street, in Washington, I remember Henry Paulson, Ben Bernanke, all the big people were saying not to worry, subprime is contained, it's just this small little segment of the market, the housing market is fine, don't worry about it. Now I, of course, was on television at the same time saying that's not true, this is just the beginning, it's the tip of an iceberg, it's not a subprime problem, it is a mortgage problem. Yes, you're seeing it in the subprime first, but just wait a little while and you'll see that the sickness permeates the entire mortgage market, and this is a major, major problem. It's going to be huge. Of course, I was right about that. It's the same situation with sovereign debt. All the experts that said don't worry about the mortgages, they're also saying, hey, don't worry about the sovereign issues. It's not going to come to America. I mean, it's just these subprime, these big countries, but America is immune. We don't have to worry because we've got a printing press. As if somehow having a printing press is going to be comfort to our creditors when we actually use it to pay off our liabilities. Yes, we don't have to default in a technical sense of the word. We can give everybody back their dollars, but when they can't buy very much or anything with those dollars, it's going to be little comfort that we paid. But I think that we are working our way up the food chain, and we're going to deal with the sovereign debt issue. I think right now, the fact that Europe is dealing with their problems first is buying us some time. You know, unfortunately, we're not using that time wisely. In fact, it's just extra rope that we're using to hang ourselves, because since we are benefiting from Europe's problems in that it is keeping treasuries low and the dollar higher, it is simply enabling the U.S. government to postpone making necessary cuts in spending because it can borrow the money instead. And it can only do it because rates are low, which really gets to the heart of the problem, in that America itself as a nation is making the exact same mistake that the subprime buyers made in the real estate market. We are borrowing money because it's cheap, and we're borrowing short. We are not selling a lot of 30-year treasuries or even 10-year treasuries. The majority of the money the federal government is borrowing to finance the debt matures in under a year, or short term. It might be 2 or 3 years, half of it, but I think a third of it matures in a year or less of the whole entire national debt. So in other words, we have an adjustable rate mortgage on the national debt, and interest rates are at historic lows. What happens when interest rates rise? Well, we're in the same predicament as the mortgage borrower. We can't afford those higher rates. Not legitimately. We can't raise taxes to cover it. All we can do is just print even more money. And that's what I think we're going to do. But that is what precipitates a crisis. And I think it's going to play out like this. You're going to start to see a drop in the dollar. A dollar index is going to crack through record lows. It's going to start to put upward pressure on interest rates. But it's definitely going to put upward pressure on consumer prices. And you're going to see consumer prices, which are right now, year on year, the government is acknowledging a 3.8% inflation rate, which again, it's much higher than that. But pretty soon the government is going to have to start acknowledging inflation rates north of 5%. And then what is the Fed going to do about it? Is the Fed going to continue to pretend that there's no inflation? It might be able to do that for a little while, but then it loses any credibility that it has left. Well, I don't know why it still has any. If it doesn't raise rates to try to combat that, or to try to put a floor beneath the dollar, which will be, of course, falling, or the Fed is going to raise interest rates to try to fight off the inflation, but the minute they do that, then they're going to bring on a financial collapse much greater than what happened in 2008, because then the bailouts are off the table, because the Fed can't be easing and tightening simultaneously. So if the Fed decides to tighten, then it can't bail anybody out, which means the banks are going to fail. The government is going to have to restructure its debt, meaning it doesn't pay 100 cents on the dollar. We're going to have to go through an enormous decline, which of course is a positive, is a step in the right direction. We have to do that anyway. But the question is, politically, is the Fed going to do that? Are they going to let the banks fail? And the reason I'm saying the banks are going to fail, if interest rates go up, the banks are toast. I mean, think about the balance sheet of a typical bank. The banks have a lot of long-term, low-yielding debt, whether it's mortgages or government debt. When interest rates go up, the value of those assets plunge. In addition, how are banks making money? They're borrowing from the Fed and they're investing in these assets. Well, when interest rates go up, the profits turn to losses. So the banks are insolvent. Meantime, when the economy turns down, commercial real estate really gets hit. All their portfolios of commercial real estate, their home equity loans, their second mortgages, I mean, all this stuff is going to get clobbered. I mean, the banks, if we have a situation where the U.S. country is over-levered, where Americans have borrowed too much, they're loaded up with credit card debt, student loans, auto loans, home mortgages, and no jobs, no way of paying it back, obviously the losses are going to hit the people that loaned them the money. One way or another, the creditors are going to lose. Either they're not going to get paid back, or they're going to get paid back in money that has very little value. Those are the only options. There's no way they can be paid back in legitimate money. So the question is, which path will the government choose? Will it decide to try to postpone the pain for a while longer and destroy the dollar, destroy the U.S. currency, and ultimately obliterate our economy even worse? Or will we finally bite the bullet, acknowledge all the mistakes, raise interest rates, and let the chips fall where they may? But either one of those two scenarios is going to take place. And either way, we are going to get a real economic crisis, a real financial crisis in the United States, not what happened in 2008. And there is no bailout waiting for us. We don't have a European Union that's going to come to the rescue like you might have for Greece. And the problem is, we have already had countries that have been bailing us out. Look at China. China has over $2 trillion of our debt. That's a $2 trillion subsidy that the Chinese have already supplied the American economy. How much more are they going to give? We've just voted in the Senate to potentially put some kind of punitive tariffs on China. I don't actually think for a minute that we would do it. I mean, we're not that stupid. But China is, one of the biggest. They're bearing the lion's share of the burden of propping up the U.S. economy because they're supplying us with all this cheap money, and they're supplying us with the merchandise. I mean, imagine where America would be if China wasn't there. Imagine how much higher prices would be for American consumers. Imagine how much higher interest rates would be for American debtors and for the government. So we need China. Of course, China doesn't need us, and the danger is that they figure that out. That they figure out that if they just let the dollar collapse, then they won't need our export market because their own citizens will be rich enough to buy their own products. Because when the RMB goes up, that creates purchasing power in China. And the Chinese are going to be better off if they can consume their goods rather than just send them to us and get